Imagine a scenario where the world's most powerful central bank, the Federal Reserve, holds trillions in assets, a legacy of unprecedented economic interventions. Now picture an architect of monetary policy, a figure like Kevin Warsh, proposing a radical re-engineering of that colossal balance sheet. The implications? For Wall Street, for Main Street, and for the global economy, they are nothing short of transformative. Wall Street is deeply engrossed in deciphering the potential strategies Kevin Warsh might employ to shrink the Fed's massive portfolio. This isn't just about technical jargon, it's about unwinding years of quantitative easing, recalibrating interest rate expectations, and potentially ushering in a new era of monetary policy. We'll dissect the various options, from active sales to passive runoff, and analyze their cascading effects on market liquidity, asset prices, and the very fabric of global finance. This is a deep dive into the financial engineering that could reshape the next decade. Let's ground ourselves in the current market reality. As discussions around balance sheet normalization gain traction, we see immediate reverberations. The Dow Jones Industrial Average, for instance, exhibits a subtle but perceptible sensitivity to any hawkish rhetoric from Fed officials, with sector rotations hinting at investor unease. Similarly, the 10-year Treasury yield, a barometer for long-term borrowing costs, reacts swiftly, reflecting expectations of higher rates, as the Fed potentially steps back from its role as a major bond buyer. This is not mere speculation, it's observable market behavior. The Investor Sentiment Index right now is a complex tapestry. While some investors interpret a shrinking Fed balance sheet as a return to normalcy and a sign of economic strength, others eye it with trepidation, recalling past taper tantrums. We're seeing a calculated dip, certainly not widespread panic, but rather a strategic repositioning of portfolios. Money managers are stress testing their models against scenarios involving reduced liquidity and potentially higher volatility, especially in fixed income markets. The smart money is watching for signals of the Fed's preferred method for portfolio reduction. While Warsh's proposals are fundamentally economic, they carry significant political undertones. The very existence of the Fed's expanded balance sheet is a legacy of legislative responses to crises like the 2008 financial meltdown and the COVID-19 pandemic. Any strategy to shrink it must navigate political currents, particularly concerns about economic growth and job creation. There's an inherent tension between the Fed's mandate for price stability and maximum employment and the potential impact of a balance sheet reduction on these goals. The hidden agenda, if you will, behind advocating for balance sheet normalization extends beyond pure economics. It's about restoring the Fed's conventional policy toolkit, ensuring it has ample room to maneuver in future crises. The larger the balance sheet, the more constrained the Fed can feel in its ability to deploy traditional interest rate policy. For figures like Warsh, a return to a more nimble and less interventionist Fed is a foundational principle. This isn't just about financial health, it's about institutional credibility and long-term policy effectiveness. It's a move to ensure that the next economic downturn doesn't necessitate another unprecedented expansion of the Fed's holdings. A shrinking Fed portfolio creates clear winner versus loser dynamics. Sectors heavily reliant on cheap and abundant credit, such as high-growth technology companies and highly leveraged real estate investment trusts, could find themselves on the losing side as borrowing costs rise. Conversely, financial institutions, particularly banks, might benefit from a steeper yield curve, enhancing their net interest margins. Asset managers focused on value stocks or dividend-paying companies might also see increased interest as investors pivot away from growth at any cost narratives. This recalibration directly impacts the buying power of the middle class versus the profitability of corporate giants. Higher interest rates, a potential outcome of a shrinking balance sheet, can translate into more expensive mortgages and auto loans, eroding the discretionary spending power of average households. Meanwhile, corporate giants with robust balance sheets and less reliance on new debt may be better positioned to weather tighter credit conditions. We could see a widening of the wealth gap as capital becomes more expensive, favoring those with existing capital. Specific sectors like energy, with its relatively inelastic demand, might see less direct impact, while tech, particularly early-stage companies, could face increased pressure to demonstrate profitability over pure growth. The news surrounding a shrinking Fed portfolio, though highly technical, undeniably trickles down to affect the common man's psychology. When the cost of borrowing increases, even indirectly, it translates into real-world anxieties. Mortgage rate hikes, for example, can lead to concerns about housing affordability and homeownership dreams. While we're not seeing a widespread run on banks, there's a subtle shift in consumer confidence. people begin to exercise more caution in their spending and investment decisions. The brain drain phenomenon, though not directly linked to balance sheet reduction, can be exacerbated by any perception of economic contraction or reduced opportunities. This is where economics tangibly connects to human behavior, a sense of tightening belts, a shift from optimism to prudence. The Fed's balance sheet actions reverberate globally. As the U.S. Fed potentially reduces its bond holdings, it inevitably influences global liquidity. Emerging markets, in particular, often feel the ripple effect most acutely. A stronger dollar, driven by higher U.S. interest rates, can make dollar-denominated debt more expensive for these nations, potentially triggering capital outflows. China's trade policy, for instance, could find itself subtly influenced by these shifts, as global demand dynamics and currency valuations adjust. Regional stability, especially in areas dependent on foreign capital flows, can also be indirectly affected by a more restrictive global monetary environment. To find a historical mirror, we can look back to the period following the 2008 financial crisis, specifically around 2013-2014, when the Fed first began discussing tapering its quantitative easing program. The market reaction, famously dubbed the taper tantrum, saw a sharp sell-off in bond markets and a surge in yields. While the current environment is different, economic growth is stronger, and inflation is a more pressing concern, the underlying principle is similar. Markets react to the withdrawal of central bank support. We're seeing a more sophisticated, perhaps more managed version of that reaction now, as investors try to anticipate the Fed's next move without the same level of surprise that characterized 2013. The discourse among experts regarding the Fed's balance sheet reduction is robust and multifaceted. Some economists, often dubbed the hawks, argue that a swift and decisive shrinking of the portfolio is essential to combat inflation and restore market discipline. They believe that years of quantitative easing have distorted asset prices and created moral hazard, and that a cold shower is necessary for long-term economic health. They posit that while there might be short-term pain, it's a necessary bitter pill for sustainable growth. They might even suggest that delaying the process only risks a larger, more disruptive adjustment down the line. Conversely, a more dovish perspective suggests a cautious, gradual approach, emphasizing the risks of disrupting fragile market stability. These experts warn that an aggressive unwind could trigger market volatility, tighten financial conditions excessively, and potentially push the economy into a recession. They might argue that the current economic recovery is still delicate, and that premature tightening could undermine job creation and wage growth. Their view is that the focus should remain on managing the transition carefully, minimizing shocks, and allowing the economy to absorb the changes at its own pace. Both sides present compelling arguments, highlighting the complexity of this critical policy decision. Based on current data and anticipated Fed communication, our 3-month outlook leans towards a sideways to moderately bearish trend for risk assets, especially those sensitive to interest rates, while bond yields could see continued upward pressure. This isn't a forecast for a crash, but rather a period of adjustment, as markets digest the implications of a less accommodative Fed. Corporate earnings will be scrutinized for their ability to withstand higher borrowing costs, and any signs of economic slowdown will amplify concerns. For our viewers, here are 3 clear steps to hedge risks and identify opportunities. Reevaluate your fixed income exposure. Consider shortening the duration of your bond portfolio to mitigate interest rate risk. Explore floating rate notes or ultra-short-term bond funds. Focus on quality and value. In equities, pivot towards companies with strong balance sheets, consistent free cash flow, and a track record of profitability. Sectors like consumer staples, utilities, and healthcare, often less sensitive to economic cycles, might offer relative stability. Diversify geographically. While the U.S. Fed dominates global financial discourse, consider diversifying into international markets with different monetary policy cycles or stronger growth narratives, but always with a thorough understanding of currency risks. The unwinding of the Fed's balance sheet is a monumental task, fraught with both challenges and opportunities. The question remains, can Wall Street, and indeed the global economy, gracefully navigate this unprecedented path towards monetary normalization? What do you think? Will Warsh's options lead to a smooth transition or a period of significant market turbulence? Share your thoughts in the comments below.